Hi everyone, this is Michael Bengiat with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for March 11th, 2023. Okay, so what happened this week? We had a pretty ugly week. It was a fourth straight day of losses on Friday. We did see quite a bit of turmoil and disruption. After the Fed regulators, they actually closed the tech-focused lender Silicon Valley Bank on Friday, and it was the biggest U.S. bank failure since 2008. And it really caused a lot of issues with regional banks. And the top S&P regional bank ETF actually went down 16% for the week, which is something we don't really see. And the worry is now there's going to be some major contagion that's going to, feed over to the rest of the market. And part of this is just because I've talked about this a bunch of times on previous videos. It's like, we've had in 1 year, interest rates go from basically 0 to over 5%. And the market acted like it was no big deal. Like it has no repercussions. It doesn't make any difference. And of course, there's going to be some disruptions. And that's kind of what happened with Silicon Valley Bank and a few other banks too that were. And it's now causing some other issues, is that a lot of startups, a lot of kind of more tech-heavy players and growth stocks, they were using the bank as kind of their, for liquidity and stuff. And a lot of them had a lot of money sitting in there that was uninsured, because remember, the FDIC insurance only goes up to $250,000. And I saw a few headlines of Roku had quite a bit of cash there, and we're talking millions and millions of dollars that is no longer available. So there have been reports of a lot of companies couldn't meet payroll on Friday. It could turn into a mess, or it could just be a little blip, but we don't know. So, but anyways, that was just kind of the icing on the cake for the bears, and we just finally got a big plunge that sent the market into a downtrend. So we're back in a correction. We just saw quite a lot of distribution or institutional selling days going on. I think we hit 5 in the NASDAQ and 6 on the S&P. That's just a lot of institutional selling going on. So it's now knocked us down. Now, once we go into a correction, we stop counting the institutional selling days. So that's why you see this little line. But we've now have the power trend turned off in the NASDAQ. So that's under pressure. Well, actually, it's under pressure, not turned off. Let me correct that. But then the market count only goes up to 5. And so both of the indexes, NASDAQ and S&P, we only have a market count of 1 out of 5, and we have 30% exposure. We're very close to going to 0 exposure. But it hasn't happened yet, so you never know. But you can just see we were at 7 out of 7 not long ago. It's just really deteriorating quickly. So in terms of our investing strategies, buy and hold is coming down rapidly, and our returns are actually improving a little bit because we are no longer 100% exposed like if you were in the buy and hold. And as the market goes down, we just go down less. So I expect if this decline continues, which would not surprise me, even to make new lows in the indexes, we'll basically probably widely beat the QQQ buy and hold and the SPY. Now we're not just doing as well against SPY. I think just because that was a stronger market and it just kind of went up while we weren't really exposed at all for a while. But anyways, these are all short-term things. The strategies work, so we'll just see how it plays out over time. So what I do now is just kind of go through quickly the major indexes. So you can see here, the Dow was the strongest index for quite a while. It really just blasted off in October, came straight through the 200-day, which is the black line, the first one to do that. Where you can see other times it got up to that level or just exceeded it for a couple days and then plunged. So we really stayed above it for quite a long time. And this was actually a bullish little cup with handle that was forming here. And as a stock, you're kind of expecting this is going to go at the top, and it didn't. And it started to underperform versus the S&P, and you can see that in the relative strength. So for whatever reason, those 30 stocks just, the money flowed out of them, and we really now broke below the 200-day and on high volume, really not looking good. So we'll see what happens, next week. But at this point, the expected, I would expect more downside. S&P, same thing. We finally just cracked the 200-day and the 50-day in 2 days. Really just really making that look very weak technically, on also high volume too. The Nasdaq, all same thing. Just kind of cracked open and high volume, not looking so good. But I'd say the worst performer, which was actually one of the strongest, was the Russell. We were starting to see a lot of small and mid caps. Remember, the Russell 2000 is a small cap index, but we were starting to see those names which really hadn't had a lot of action in a long time, because mega caps and the large caps really were the strongest stocks for many, many years. So it was very constructive that we started to see more of these small names starting to move, but really they just fallen apart the last few days, and we are really close to taking out these January lows. So really just a lot of weakness there. And that's, taking a look at the technicals, you can see here we were at 60% of stocks above the 200 just less than a month ago, and we're down to 40. You can just see here, look at the ratio, it's just all red. Really just the 52-week lows are just swamping the highs now. We're below the 50 and the 200 on the NASDAQ. One of the tip-offs was, you can just see the number of growth stocks that broke out and held just even while the market was looking pretty strong. Remember, this is the end of February going into March. Let's go back to the NASDAQ here. So here you can see we were just kind of right in this area here. It was looking pretty good, but you can see here the number of stocks that were holding these breakouts were just deteriorating slowly but surely. And remember, the indexes are made up of stocks, even though there's a lot of them. But when we're looking at the leading stocks, that's what these are. These are stocks that are making, breaking out of bases, and they're not the bottom fishers that are down 90%. So you can see this was really a kind of a tell that it really wasn't as strong under the surface. And then finally here, the down volume, we've just been swamping it the last couple of days. So this is really, really weakened. This is part of our big database that we don't show all the time. In fact, we don't really show it ever. I just kind of threw it in this today. And you can just see here how quickly the picture is deteriorated. Just the amount of, we can see here, most of the averages were above the 50 and 200. We even had some alignment, which means that the 200 was below the 50, which is below the 21, and below the 10, or the other way around. And just now it's solid red, no. And then, which is interesting, is that on the sentiment side, we really starting to see very quickly, we've gone to extreme fear and the CNN fear greed. We were at, not a month ago, we were actually in extreme greed, I think, just briefly. The put call has shot up, the VIX has shot up, the Investors Intelligence Weekly Bulls and Bears really didn't do anyone any service, because it really shot up in terms of the bulls. This is a contrarian indicator. So again, when the people were getting more bullish, that was when the market really started to decline. So that's why these are all contrarian. But overall, there's a lot of the sentiment really deteriorated, and we're maybe considered a little over. We're not to the point where we're panicky, but we're getting there. So we might expect a bounce anytime. This is a chart for the VIX that I've showed that's actually turned out to be the fourth time that it's been working. Is that you can see here, whenever the VIX got down below 20, that was usually the top in the market. So this black line here is the S&P. You can see here we got down to 16.34 back in last January. So a year and 15 months ago, and that was the peak of the S&P. Again, we came up, a lot of volatility, came back down to 1845. That was the peak. Here in August, we came down to 19 and change. That was the peak. And then we recently got down to 1706. So it's actually not quite the lowest, but we were thinking maybe that was, it looked like maybe because we started to come up here and the market was doing well. But now we had a big giant spike here on Friday. So again, getting down to that level really has been a powerful sort of contrarian indicator of complacency when you're down below 20. Now, and right now the VIX is at 24.80. So that's just telling you we've reversed several times. Now, for this market to get into a nice uptrend that we're not getting tested all the time, you're not getting stopped out every single position, we've got to see the VIX get below 20 and stay there for a long time. And that's something we've seen here. This has been almost solid red for month after month after month, and that's not normal. You can just see that since, for the last couple of years, it's just been extensive volatility, which has made, trading stocks very difficult. It's easy to get chopped up and kicked out, which is what we've seen for quite a long time. So we want to see it get down there. And if you look at a chart, I don't have it in here, of times when the market has really been cruising, just slow, nice and easy, steady increase. It's when the VIX has been down, actually, even below 15, down to 12. That's the sweet spot. If you can get there and stay there, then usually the trend is just nice and up. Stocks just are up, going up on balance, not a lot of volatility. There's just not these huge shakeouts and plunges that we're seeing. So, but that's what we're looking for. I mean, it'll happen. We just don't know when it's going to happen. So, unfortunately, this is what it's led to, another correction in the market. So, just to wrap things up here, I've been showing this chart, this slide for a while. Now I've actually crossed out the make or the make or break, because we actually just broke, and it's been a dangerous market for quite a long time. So a couple things I just want to point out here is that volatility is going to continue in the first half. When this calms down, we don't know. So it's making, of course, as mentioned earlier, it's making trading really difficult. Now, one thing that's been interesting is that part of the reason the market can't get really anywhere is because this is just a chart of the 1-year treasury and the yield, and it's just been marching higher and higher. You can actually see here where the market kind of started to flatten out. I mean, the yield flattened out. The market started to think that was the end of the interest rate hikes, and that's it. Up and away we go. But we ended up breaking out to new highs. Now, we had a big move down on Friday, and this is what we probably need to see. If this can finally break this uptrend and start going down, it's probably you'll see the market really start to take off. It doesn't look likely because the Fed is really not in any place to start cutting interest rates, but the market may force its hand. But it could be that this blip just was because of the panic in the banking sector on Friday, and then people rushed into the quote unquote safety of treasuries, and of course that sent the yield down and the price up. So we'll see what happens here, but we're not even at the 50-day. That's this black line. So we haven't really seen any kind of pullback, and this could just be a blip, and we'll probably go straight back up. Okay, so next week on Tuesday we have another probably big market moving report, which is really getting tiresome. It's just the market is just lurching from one day to another. Every single report that comes out, and sometimes there's 3 or 4 a day. It's just really getting tiring and exhausting. Which for a lot of people, they get exhausted and worn out and they leave. And those are the weaker hands. So maybe in a way that's good. Hopefully you're not one of them. Again, you don't have to trade all the time. There are times to be out, and if you're in a bear market like we are still in a bear market, cash is the best position. In fact, now you can get 5% on your cash. Most people are not getting 5% of their stocks, and you get it with really no headache. You just put it in a high yield CD and just forget about it for a year. So anyways, coming back to this, we're going to get the CPI in Tuesday, probably more fireworks. And then again, we've been talking about this every week. You got to respect the trend. The trend was up. Last week it looked really strong, and then it just a couple days and it's not. We're going back down, and you got to respect that. You don't want to say, well, this is now the time to keep bottom fishing and buying every dip. That buying the dip, I think, is one of the problems with this market overall. You could just see it. I mean, even on these volatile days, we'd see I would watch sometimes the NASDAQ would be down 150 points, and then out of nowhere, buyers just pour in, and it goes green. I think it did it on either Thursday or Friday. And then by the end of the day, you're down at 200. So it's just this, it's like this, market opens lower and the buyers just compiling in every single time. And that's not a winning winning strategy. I mean, this is what happened in 2021 and 2022. People were buying all these, the trade desk. It was almost 1,000 a share, and they kept buying it and buying it and buying it, and it just kept going down and down and down. So this is a problem. I think that mentality needs to go away before this market can really have a sustained move up. So coming back to this, and this is the final thing, you got to respect the trend. The trend is now down again, and it may last for a while. It may be over in a few days. So what we're looking for now is we're looking for that initial rally day, which will be the first day the market closes up, and then within 4 days, we're looking for a follow through, and that's going to be a day on much higher volume than the previous day. The bigger the better move. We want to be at least 1.25% on higher volume. The bigger, the more powerful it is. And so if we don't get that and it breaks new lows, we start over. So we're in that sort of waiting mode to see if we can start a new uptrend. But I wouldn't expect it to happen right away. Really hard to tell. I mean, the big plunge due to the banking sector could be, as I mentioned earlier, just a little blip, overreaction, and up we go. Because now they're seeing that interest rates are a little bit lower. It's really hard to tell. It's just an emotional market, but just like anything, if people are emotional, just like people are the ones doing this trading, they make mistakes, they overreact, they do sometimes stupid things, and that's what the market is doing now. It's I can't tell you if it's overreacted. This could be the beginning of a massive plunge down because that interest rate problems are now popping up all over the place. We don't know. I mean, remember, back in 2007 and 2008, nobody, including the Fed, said, this is just a little blip before the financial crisis really hit, sending down, so many stocks. Citigroup was, I think, a $5 stock or something like that. I think Bank America was a $4 stock at one point. So we don't know what's going to happen. So again, you want to respect the trend. If it's down, you don't be buying stocks. Just wait till the market's telling you it's time, because at this point you just, the odds of losing money are just very high. So we'll see. So anyways, Tuesday we have another big report, and then coming up very soon after that is another Fed meeting. I think it's on the 22nd. I may be wrong about that. And we'll see what happens. So at this point, just stay out of the market. Just follow it and see what's going on. But we have very little exposure. And on the stock side, really, it's just really not working. Now, one thing I do want to just finally point out, this indicator here has been very powerful. It just looks like one little indicator. But we've been solid red for a long time, I think almost this whole year. And it's just because this is following leading stocks and non-indexed ETFs. And it has just not been giving us any sign that we should be in this market in any kind of size. And that has been working out very, very well, because overall the market is just, it goes up, but it's just been falling apart. This can't last. So really, heed this indicator. When this goes green eventually someday, we're going to be in a rip-roaring market. And that's when money will be quick and easy to make. There'll be no pressure on your account. Everything you buy will basically go up, and it'll go up a lot quickly. I don't know when that's going to be, but it will happen sometime in the future. So keep your eye on this guy. This is a key one. And when they're all lined up, and we had solid green for a while, and that was sitting in the red, and that was that kind of canary in the coal mine. We didn't get confirmation from what the best stocks were doing, while the indexes, again, driven by a lot of the mega caps and large caps, were just kind of heading higher. A lot of bottom fishing was going on. People were pouring right back into all the old tech leaders. Well, now they're starting to fall apart again. So anyways, just keep this guy, keep your eye on it. It's super important if you're a trader to know if there's congruency across the whole stock market, and we just have not seen that for a long time. Okay, thanks a lot. We'll be back next week. Okay, bye-bye.